So when it comes to the stock market, we're going to go back to basics. Now, myself, I have 17 years experience in financial institutions, working with a lot of financial advisors, but a lot of questions that I've been getting lately from individuals, from viewers, have been talking about where is the basics? How do we know the basics? How do we start investing in the stock market? Exactly what it is. That is what we're going to be covering in today's live stream, starting off, of course, with the very basic. What is the stock market? Now, of course, the stock market, also called equities. Now, this is where you can buy interest in publicly traded companies. This is really the stake in the business. This is when you're owning a business or a company, which essentially you're buying a piece of a business. Now, of course, when you look at the stock market, it is the collection of stocks or the collection of businesses that are publicly offered that you can buy and trade. Now, of course, the big reason for this is publicly traded companies do want to raise funds to research and development, for marketing, for growth. They really want to prosper in the future. And this is the means that a majority of companies, including Reddit's IPO that is coming pretty soon, that raises a ton of money by offering public stock. Now, the shareholders get dividends if they are offered, but they also get the appreciation of the price of the share itself. But you have to be careful, because just like with anything, when you look at Toys R Us, when you look at Kmart, there's also a possibility that companies shrink, disappear, really not relative with the time anymore, or they completely run out of money like Bed Bath & Beyond and they declare bankruptcy. And at that point, the stock really isn't worth anything. Now, when you think of the stock market, again, as a big entity, it is kind of the aftermarket. So the aftermarket is where people do the buying and the selling of the shares of these publicly traded companies. This, of course, is the stock exchange. Now, you have the New York Stock Exchange, you have the NASDAQ. And if you go back even, 20, 30 years, most people had to do this on a trading floor in a physical location. As of now, almost everything 100% is virtual, or, you actually don't have to be there. So when you look at some of the biggest parts, or kind of the basis of it, the S&P 500 is one that I've talked about in a lot of my videos. And I know a lot of people had questions about this. So when you look at the S&P 500, it is made up of around 500 of the largest publicly traded companies in the United States, while the Dow Jones includes 30 large companies, and this tracks the performance of a specific collection of stocks over time. And again, thinking of the Vanguard, the VOO, the Vanguard S&P 500, this is one where if you're not going to go in, and we'll get a little bit more in depth into this, into one specific individual stock, you can actually buy the entire indexes, which I highly recommend, because not only are you not buying one company, 100 companies, you're buying 500 companies with one specific ETF. Now, of course, when you look at the markets, it is really a group of these thousands of publicly traded companies, and they're not just in the US. You can also trade companies that are foreign entities, that are foreign companies. And I believe the last count that I seen was around 30, I think it was 35 to 37,000 companies worldwide that you could actually invest in, which is kind of crazy. But of course, to start all of this, you have to start with a brokerage account before you start investing. Again, this was a question that I got right off of the bat. Individual said, I have a bank account, I have a credit union, I have money in there. I don't understand how to get it from point A, being at a financial institution, to point B, getting it invested into the market. That, of course, is the brokerage account. Now, if you look down below in the description, I have a link to Robinhood and I have a link to M1 Finance. Those are the two brokerages that I use. There are a ton of them out there. If you look at, Wealthfront, Vanguard, Zoe, Betterment, Fidelity, Robinhood, like we mentioned, there's a ton of different places that you can buy. It does go through kind of like a verification check. You go through two-factor authentication, which you have to set up if you want Face ID, whatever your phone or your computer really utilizes. Make sure you're keeping your account safe, because this is going to house all of your investments when you do get this set up. Now, once you go through there, you do the verification, which Robinhood took me about 5 minutes. I actually have, again, 2 accounts, one on Robinhood, and then I do have one on M1. Now, both of them trade stocks, trade ETFs, also do have a crypto aspect. But again, we are staying with the basics. So, of course, starting at the very basics, buying the right investment. So buying a right stock is much easier said than done. Anyone can see a stock, kind of how it's performed in the past, but it's very difficult to understand exactly how the stock could perform in the future. Now, when you look at the just absolute multitude of information that you can get depending on where you're looking at it. But being able to analyze a company and really managing the investment is what a lot of people have to look at. And a lot of people don't want to do this at an individual stock. When you look at your Apple, when you look at Tesla, when you look at Nvidia, a lot of these stocks, it's very difficult to really gauge. Of course, you can see the past performance, but it's very hard to see the future performance or how well it's going to do this. So a lot of people do look at the P/E ratio or the price earnings ratio, for example. This is kind of one of the basic fundamentals that they have, looking at the management team, looking at the competitive advantage, studying a company's financials, including balance sheets, income statements. These are just literally scratching the surface when it comes to the fundamentals of a company. And if you go to, a different ticker symbol, if you go to a bunch of different websites, they will kind of break down all of this for you, but you kind of got to know exactly what it means. And that is the reason why I do not go ahead and invest, and I do not advise you at all, being a beginner or even being an intermediate investor, not buying individual stocks. When you look at this, to buy a stock, you're kind of putting all of your eggs into one basket. Even if you buy 3 stocks, 5 stocks, 10 stocks, when you look at this, you're buying a particular company, and you're also buying the performance of the company, the history of the company, also kind of where it's going, research and development, what the future looks like, but you're also buying into different industries. That is why it is very hard and honestly, very hard, even with me, with a multitude of years of experience, to really pick individual stock winners. It can be incredibly hard to, because of course, for every buyer, there is a seller. There's somebody who is dropping that company or getting rid of that company, while there is another one that is actually buying that company. There we go. So Charlie has 75 in the VOO, 25 in the SCHD, and 25 in the VUG. I do like that, Charlie. That is a very good stock portfolio to be invested in. That I know your math is a little bit off. I think you're doing 50, 25, 25, which I do like. So essentially with there, I know there is going to be some overlap, and we are live, guys. So if you got some questions, pop them in there. If we're doing 50% VOO, like we said, you're 50% invested into the top 500 500 companies in the United States. The SCHD is actually the Charles Schwab High Dividend Yield Fund. So with that, you're actually getting a pretty good dividend in there. And you're also getting a little bit of risk mitigation, because they're kind of separate for the companies that are buying or yielding those dividends, and the companies that are in the VOO. I like that as well. And the VUG. Now, the big thing with the VUG is, if you look, again, looking probably at the last 10 years, Charlie, the VUG has outperformed the VOO by a massive amount. And this is because of really the Magnificent Seven. So when you're looking at Microsoft and Apple and Nvidia and the rest of those that fall in that category, the growth funds have absolutely been crushing it. And the VOO or that S&P 500 has been lagging behind where the VUG has been performing. And that has been true over the last decade of performance. So I like the mix. I like the breakup. And a lot of people also ask me about that, is when you look at the VOO and the VUG, it has a really big overlap. So the VOO, like we said, has about 500 of your stocks. The VUG has, I believe it was 208, if I recall correctly, but with having a very minimal 208 stocks in the VUG, which again, we'll get into a little bit. The overlap is there, but you're a lot more heavily invested in some of those higher growth companies, which is exactly what you want. So that is definitely a good portfolio to be in. And again, if you're going 50, 25, 25, the 3 ETF portfolio is a very simplified portfolio that has been absolutely crushing it. When you go back 10 or 15 years, it has done incredibly well. Yeah, that's what I thought it was, Charlie. I thought it was the 50, 25, 25. Absolutely. That is a good 3 fund portfolio right there, which is awesome. That again, it's really well balanced. You have, exposure to all of the sectors, focusing on growth, focusing on the S&P 500, and then a very strong performer with that SCHD. And that's what we're going to talk about kind of on the next step, is looking at individual stocks, like we were saying, not investing in individual stocks. This is where your ETFs come in. This is where the exchange traded funds come in, because these funds will hold dozens, if not hundreds, if not thousands to 10,000s of stocks all in these. You can actually do a global fund. Like we said earlier, it has about 37,000 stocks in it that are worldwide. So you're encompassing every single publicly traded company. And I believe it is in the world that they have in some of these ETFs. So like Charlie was just saying, if you went in for the VOO at 50%, SCHD and the VUG, you would have a very well-balanced portfolio. Again, there is a little bit of overlap in there between the VOO and the VUG, but both of those with the growth factor being in the VUG, I definitely like that portfolio. And if you looked at mine, where we're investing $1,000 a week, that is almost the portfolio that I have. The only addition that I have for that one, Charlie, is I carry the QQQM, which is the NASDAQ 100. Now, of course, looking at something like that, talking about creating a diversification or a diversified portfolio. If you're an individual that goes in here and you're buying those index funds, if you're buying those ETFs, you immediately have a diversified portfolio if you're in a couple different ETFs. Now, of course, if you own that S&P 500 or the VOO, you will own 500 companies. And of those 500 companies, you are diversified across all of the industries that we do have within the stock exchange, which makes it incredibly, incredibly diversified. And of course, if you're a new investor, like we were talking about for the stock market basics, it is the way to go if you're looking at a solid investment strategy, because we don't want to actually pick those individual stocks. Now, again, when you're looking at those ETFs, there are a lot out there that are super particular to certain sectors. You really have to do a little bit more research, see exactly what companies are within those sectors, because essentially, not only can you invest in the entire S&P 500 itself, but you can also segment this in these stock portfolios or these ETFs 1,000 different ways, where you can just put everything into one sector. You can include a couple sectors. You can break up portfolios. There are so many ways to really break this down. But when it comes to diversification, this is a very easy way to do it, making sure that, again, you're not carrying all of the same stocks within the same ETFs, which of course is what we do see sometimes, where if you're carrying something like the VUG, which is heavy growth funds, and then you're going ahead and buying a sector like our tech industry with a sector right there, the VUG and the tech side, the tech ETF is going to have a massive overlap, meaning you're literally buying the same thing on both ETFs, which again, you want to make sure there's not that much overlap, but some of it is okay to a certain extent. Now, of course, with any marketing or with any stock, with any investing at all, you have to be prepared for the ups and the downs. This is the big part, especially for beginners, where they can't stomach the loss of investment. If the investment's going up, great. If the investment starts going down or they start losing money, most people will panic sell. Now, this is the point where the stock market, you have to think about it kind of taking the emotional aspect out of it, as difficult as it is. If you really want to be a solid investor and you want to be, a long-term investor, you take really the emotional aspect out of it, that if a stock is up, great. It doesn't make a difference if a stock really is up, doesn't make a difference if the stock is down, unless you're looking to buy or sell that stock. That is really the only time that you're looking to. If you're looking to move position, that is the time where you either take your gains if the stock is up, or you take those losses if they are down. Now, with the diversified portfolio, like I said, there are going to be ups and downs. In the good, when you think about this, when you think of 2022, so 2022, stock market was down about 20 to 25%. For a lot of people, they sold out of the market. That is what continued to drive those stock prices down, was all of the people were selling. They were getting out of the market. It was going down. They didn't want to go with the ship. They went ahead and they were pulling out of the market. On the flip side of that, investors like myself, everything is on sale. If you're talking a 20 to 25% discount on all of these stocks and all of these ETFs that I love to buy, 100% absolutely sign me up. In that year, we put about $40,000 into our investment account, and we were buying it at a 20 to 25% discount with all of those ETFs. That is the reason when it came back in 2023, my portfolio was up 62% in the last 2 years, and there is a very solid reason for that. What about the Reddit IPO? So Charlie, that is a very, very good question. Now, I did see the Reddit IPO, which you can get into if you go to Robinhood. Um, Question with that, and it seems like they've done a lot of studies and a lot of surveys and a lot of kind of conversations around the Reddit IPO. I'm kind of on the fence because I know there's a lot of people who are, the super users of Reddit and really have the foundation there when it comes to investing. Some of them are saying buy it. Absolutely, the IPO is going to be great. Some of them are saying it's going to be absolutely horrific if you're getting into the IPO. Now, one thing to note is if you're getting into the Reddit IPO through Robinhood, they do require you to hold that Reddit stock that is going public for 30 days. Now, that is something that I noticed on Robinhood. M1 Finance, unfortunately, doesn't have the IPOs that are on there. It usually books a few days or weeks out. But overall, is it going to be a good buy for the IPO? Honestly, I stay away from IPOs. I stay away from the IPOs until because if you're doing a buy and hold strategy with an IPO, it's very difficult to know exactly where it's going to be and how exactly the IPO is going to go. And what I mean by that is we have seen IPOs in the past that were botched when they went public, when companies went public. It was an absolute train wreck. A ton of people sold them because they seen exactly what was going on. Takes a couple days and the prices will kind of stabilize on where they're at. Now, personally, I did the IPO when we did it for Rocket Mortgage. Now, Rocket Mortgage, of course, their IPO was $18. As of today, the stock sits around 10 to 12 bucks. So it hasn't got back to the IPO price. I believe one time in the last couple of years since the IPO, it got back to the original IPO price that people were buying it. Because essentially, after a couple days, the market is going to dictate through buys and sells exactly what they feel that Reddit IPO is worth. Now, of course, if you're vested in Reddit, if it's something you're interested in, and I haven't done a ton of research about the Reddit IPO, but overall, if it is something that you use, and I go back to kind of Warren Buffett's philosophy, where if you put a little bit into it, and I really take this with a grain of salt, is something that you use, something that you like, putting a little bit into it could be beneficial, but know right off the bat that you could see a loss. You could see a very big loss unless you're not putting a lot of money into it, of course. But whatever I put in there, similar to my strategy when it comes to cryptocurrency, never invest into something new unless you think that if you could lose all your money, you'd be completely okay with it. If I put, 2 or 3,000 into Bitcoin and Bitcoin goes down quite a bit, I am okay with where the price fluctuation is. If Bitcoin goes up the exact same way, I am okay with the fluctuation. If tomorrow they ban Bitcoin and Bitcoin went completely out of business and I lost what I had in the cryptocurrency, same with that, I would be okay with the loss just because I know going into it that it is a very volatile currency or cryptocurrency essentially, and that asset class could go away, could be there forever, could be the moon with it. But overall, yeah, the Reddit IPO, I kind of get away. I don't like investing in those IPOs, Charlie, because you never know. You never know exactly what's going to come. And especially with the Reddit community, if you've ever watched the GameStop saga, anything like that, Reddit could just say, you know what, on Reddit, we're going to really boycott, band together. We're not going to buy any of the IPO. We're going to let this thing sink when it comes out. And that's unfortunately what could happen to it through social media. I know it's not right, but social media drives a lot as well as the news when it comes to these stock prices. Now, of course, getting back to our basics, when you look at the changes in the stock market, like we were saying, there are going to be ups and downs. You really have to be able to stomach those losses, those gains, those losses, everything. You're going to have to really ride out the short-term volatility that we see. Now, when you think of investing, and this is really the basics, again, getting back to that, when you look at investing, we are talking about a 7+ year strategy. So putting money into, the VOO, the SCHD, we are talking about a 7+ year strategy when it comes to investing. If you're looking at, let's say, next 1 to 3 years, I want to go on vacation, I'm going to have a wedding, I want to buy a house. This is not the place. Investing is not the place to park your money when it comes to probably 5 years or shorter, I would even say, if you're looking for short term, because essentially what happens, if you could put a bunch of money into the stock market could drop 22 to 25%. like we seen in 2022, you pull all your money out. Well, now you're, 20% down on the investment that you had earmarked for a new home, for a wedding, for education, for college. Do not put any money in the stock market unless you have a longer term plan on exactly how you're going to really put the money in, when you need the money to get the money out. Now, of course, with this, if you're looking for shorter term, and again, that 1 to 5 year mark, looking at the high yield CDs, looking at, the high yield savings accounts, there's a lot of different places that you can kind of park your money. That you can kind of sit it, you can earn a pretty good return on it, and knowing that your principal is guaranteed. CDs, are FDIC or NCUA insured. If you're putting it into those high yield savings accounts, they're covered by the government as well. They're backed by financial institutions, meaning that you're not going to lose your initial investment. Now, granted, you're not going to make a ton on that investment, but overall, you're not going to be losing that initial investment. That is earmarked for something else. So how exactly do we do this to get into really the basics of the stock market? So you go in, you set up that brokerage account. You can go in there, and I really encourage people to go in there with a very, very small amount of money. So what we mean by this is, let's say, okay, you go through, you open up that account on Robinhood, you're sitting there, you put $100 in there. You can try some ETFs. You can look at some stocks. You can look at anything that you want, because of course, Robinhood and M1, they don't have any trading fees, nothing like that. So you can move your $100. You can see exactly where you want to park it. But going in there is coming up with a plan, and I really do recommend this, of exactly what kind of short-term, long-term money is going to look like, how much you're going to invest. So this is really a basis where if you're just starting out with investing, like I said, throw $100 into an account, play around with it, see exactly where it goes. You're not going to be, for most of us, you're not going to be out maybe $100 at most if that's all you have in there. There are also a lot of online stock simulators where if I bought, this stock at this price, you don't put any of your real money at risk, which you can use as well. But again, you need to understand why you're investing and what is the long-term play for this. Are you thinking about, retirement? This is where you're putting money away? A lot of institutions, a lot of jobs don't have 401k plans, don't have pension plans. So when it comes to investing, this is the only option that you have, unfortunately, is putting money into just the traditional brokerage accounts versus, 401ks with matches. But I would also put it into IRA accounts as well. Now, one thing to note is if you're looking to invest in IRA accounts, again, both of the companies that I talked about, Robinhood and M1, both have IRA accounts. When it comes to the IRA accounts, you do get a tax advantage if you're doing traditional. I recommend doing Roth. And the only way that I would do an IRA account is if you're investing money that is kind of earmarked for retirement. That's exactly what an IRA account is. Individual retirement account, IRA, is putting it and investing it in the market. When you're putting it with financial institutions, most of the time you might get 1%, you might get a couple, you might get next to nothing. Even the average for a financial institution is around 0.37, which is, of course, 0.37, not even a full percent, not even 0.5% that you're yielding in these IRA accounts. If your money from your IRA is not invested in the market, I guarantee you're not going to be seeing the growth that you are or that you should be, and you're not going to be seeing really the returns that you need to grow that portfolio, because inflation is going to be eating up all of the money that you have sitting in the IRA. So definitely making sure that your IRA money is invested in the stock market. And for a lot of people, if you're, getting closer to retirement, even if you have a portion of it invested in the stock market, you need to get the growth potential out of there. That's the reason why a lot of people are doing 401ks or doing investment accounts, and they're realizing that they retire at 62, 65, 67. All of a sudden, by the time they're 75 or 80, 85, they're completely out of money. All of the retirement funds are gone. Now it is 100% reliant on Social Security and Social Security alone. And if we know historically, Social Security is meant to replace 40% of the income you are earning. That is right, guys. Social Security is not there to replace 100% of the income. So essentially, you go from full-time work to Social Security. That is supposed to supplement roughly 40% of the income that was earned when you have full-time work. But like we were saying earlier, when you look at the financial in the investing long-term portfolio, long-term growth, you have to skip the financial news. This is one of the big things. And again, having kind of that emotional detachment from the funds, because when it comes to money, majority of us have a very strong emotional aspect and an emotional attachment to money. Now, also one thing to note is if you're, just starting to invest, if you're completely new to this, make sure that and you don't have any, this is again, going back to the financial counselor in me, make sure you don't have any high yield debt or high rate debt. This means credit cards. If you're putting money into a portfolio, if you're putting into the stock market, if you're putting it into an investment account, chances are, if you are carrying credit cards, if you are carrying any credit card debt at all, you are going to be paying probably 5, 10, 15x on that credit card debt versus putting it into a portfolio. Always make sure before you start investing, before you start doing this long-term growth, that you're putting money or you're eliminating that high yield or that high risk debt, which is, of course, those credit cards. When you look at 22%, 24%, 30% on credit card debt, there isn't a portfolio out there that I know that actually has, any legitimacy or any long-term growth that is going to be paying 30% per year on a credit card. It is really a lose-lose game. Make sure that you're going in there and make sure you're eliminating that debt before you start putting money into an investment account. And of course, the best time to start is once that debt is gone, is putting money and now setting aside and earmarking a certain amount of money. And it is really, and we've said this before, it is not timing the market. Timing the market is near impossible, if not impossible. I don't know anyone that has actually done, the perfect time in the market, perfect time out, perfect time in, perfect time out. It doesn't happen, but it is the amount of time you have in the market. When we start looking at investing, like I said, with that 7+ year time frame, it is a game changer when you start getting to compounding interest. And then, of course, you look at your 10-year, 20-year, 30-year time frame. If you're putting $100 away a month and literally just earmarking it and putting away $100 a month, if you're younger, let's say 18, 19, 20, $100 a month going into an investment account, by the time you retire, just putting that $100 in, you will be a multimillionaire, and guaranteed with almost any growth rate over an extended amount of time, you are going to hit that millionaire or that multimillionaire status very, very easy. Now, one thing we hear a lot about, and this is another thing that I kind of wanted to address as kind of the basics, is short-term trading or day trading. This is something that as a beginner, it is almost impossible to do. Even for me, I've tried day trading cryptocurrency. It is super hard. When you start looking at futures, when you start looking at shorts, when you start looking at leverage, those are things that really should be addressed or really should be focused on when you're very familiar with investing. You're trading stocks. There's a lot of different ways you can do this. And I know that people on Robinhood have gotten in trouble for this and have really, I believe, even, unfortunately, I believe some younger individual took their life over the shorts, the futures, the longs, with the investing at all. You have to know what you're getting into. Thank you, Kathy. She said, thank you for all the great information. Oh, you're welcome. But what I'm saying is, what I'm getting at is, don't invest in anything. And this really goes for anyone. Don't invest in anything that you don't know and that you do not understand. Again, when it comes to futures, when it comes to, puts, calls, shorts, don't invest in anything you don't understand. Cryptocurrency, don't invest in anything you don't understand. There's a reason. And you know what? A lot of people, and we've had this conversation before, if you want to invest in cryptocurrency, my personal thought, go spend the next 100 hours or 100 hours over the next, couple months, knowing and understanding exactly what the blockchain is, exactly what Bitcoin is, Ethereum. When you look at Solana, understand what you're investing in, and you will thank me later, because essentially what people are doing is they're seeing YouTube videos, they're seeing people on TikTok, people on, Instagram that are telling them, go buy this, go do this, go do this. And they're running out and doing it. And then they're losing a ton of money and they don't understand why. This person told me to go buy this. I don't understand it. I don't know exactly what it is, but I put all my money in there and now I lost it. You have to make sure that when you start getting into the education aspect, when you start getting into the fundamentals, even for a lot of the veteran investors, even computers, that utilize artificial intelligence still have a tendency to lose money. They can be wrong. It is the human error. Going in there and buying and selling stocks frequently not only can get very expensive depending on the brokerage you're doing it, but it also can create taxes. It can create fees. It can also get your account banned if you're not licensed to day trade. So make sure if you're looking at short-term investments, a lot of people that I know personally have gotten burned from investing in a very short term. Now, again, depending on financial goals, savings accounts, money markets, CDs are the best options for that short-term money, looking at least, like I said, 5 to 7 years when it comes to investing. And the big thing here that I want you guys to take away from this is investing over time. This, of course, is the automated process where people are investing. And we see this, of course, most commonly in 401k plans. When you say, okay, I'm putting 4% of my salary away every single, paycheck, they're matching 4%. If you do get a company match, that is 100% free money that your company is giving you. If you're not taking advantage of it, unfortunately, you are literally throwing away free money that your company is offering you, but it is investing over time. So if you're at the same job for 30 years, you have that 401k set up and you're investing every 2 weeks for 30 years. It is the keeping and really the overall investing over time. For a lot of people, investment accounts, unfortunately, I've seen them also that are a tool to borrow money against. People want a new truck, they want to buy a new car, they borrow money against it. First-time home buyers taking money out of the retirement account, hardship loans, which I understand if there is truly a hardship, but a lot of people have used their 401k not towards retirement, but they've used it as kind of a giant savings account that they can borrow against as they need. But for a majority of people, it is really detrimental when it comes to the retirement account if you're pulling money out. Now, remember, this is a retirement account. It's used for retirement and retirement only. You are creating this to supplement what Social Security is not going to be paying you. So it does make a big difference. Now, again, investing over time, like you've seen me do, I've actually been investing with my company for the last 10 years. We're at a little bit over $250,000 already in there in my 401k, because I believe in wholeheartedly, if you start off investing, if you start putting 15% of your pay away, living on the rest and living within your means, that 15%, if you carry that forever. So what I mean by that is you're putting away 15% up front, then you get a promotion, still putting away 15%. You go to a new job, you're making $20,000, $30,000, $40,000 more a year. 15% is still going in there. When you get 10, 20 years down down your career path, you're making $100,000, $150,000 a year. 15% is still going in there. Again, with 15% of your income going in there, you're looking at a multimillionaire when you get ready to retire. And that is, just literally scratching the surface. If you keep with the 15%, and I know Dave Ramsey says the exact same thing, as well as a lot of financial advisors. Some people say 4%, some people say 6%, but overall, if you're putting the 15% in there, guarantee you over the extended amount of time that you will see a huge return on everything that you have in there. Now, again, just kind of recap, investing in the market does make a really big difference for a lot of individuals, again, that don't have those 401k plans. And even if you have a 401k plan, I really challenge you to go in there and look at your 401k plan and look at where your money is invested, making sure that you know exactly where your money is invested. If it's in the VOO, if it's in the VUG, really knowing where the money is at. Now, this, of course, is something that I put out to everyone as a challenge. When you look at one, what does your company offer? So if you have different stocks, if you have different bonds, if you have different portfolios, different plans, it is on you to understand exactly what is in there. And most people don't. If you take time, spend some time, do some research, know exactly what it looks like, what you should have allocated, what percentage. Now, of course, for a majority of companies, they do have, paid certified financial advisors that you can talk to. But if you have a really good understanding of what you're investing in, you can really get the confirmation from that individual that sponsors these plans, and making sure and knowing that you're in the right spot. When I sit down once a year with financial advisors, we go over the portfolio, we go over the plan, we make any adjustments if they are needed. For a majority of individuals that have those 401k plans or have those investment plans, they literally just put their money into, let's say, a target date fund through Vanguard, and it sits there forever. When you look at the return on a lot of the target date funds, they are far below the S&P 500, far below the growth funds that Vanguard has. If you move your money around, when again, you're talking a multitude of years, you're going to make way more money and you're going to have a much better retirement because you need the growth factor and you need that compounding growth factor till the point you get to retirement. Again, even looking at one of the most famous investors, Warren Buffett, he made a majority of his money past the age of 60 because of the compounding aspect that he had. So he spent pretty much his entire life, and I'm thinking even again, kind of remembering his story, about 45 to 50 years, because I think he started investing at 12 or 13. Again, just kind of drawing that from memory. But he was very young when he started investing, and he kind of invested throughout his entire life, knowing the importance of it, getting now to a multi-billionaire status. And of course, the compounding interest through all of those years have been an absolute game changer. So when you're starting again with the stock market basics, focus on those ETFs. Those are the big part. That is what I always advise, is going in, bottom line, getting those ETFs. If you want to make it really easy, very simplified, if you want to invest in one thing, and again, Warren Buffett recommends this, investing in that VOO, even if you put 100% into that VOO, which is the Vanguard S&P 500, you're mitigating your risk because it is across all the sectors. You're investing in the 500 largest companies within the United States. And overall, when you look at the last, I believe it was 10 or 15 years, you're looking at roughly a 13 to 14% growth rate of that ETF fund itself. So again, when you think big picture over the last 15 years, if you're averaging 14%, when you look at savings accounts, which are paying next to nothing, CDs that might be 4 to 5%, putting it into an investment account, and again, a multitude of years over there, 10 or 15 years, looking at a 14% year over year growth or year or average over that time frame, that is a big amount of money. Now you couple that with putting money in there every 2 weeks when you get paid, that portfolio is just going to exponentially blow up when you start getting a multitude of years in there with the contributions and then doubled on dividends that they're paying you, but also the growth factor that you do see in there. Definitely look at the ETFs. Like I said, for me, I do not individually pick any stocks. I do not own any one single company at all. I do not believe in it. I don't see the value in it. Again, if you're a veteran trader, great. If you're an intermediate that you want to pick up a couple individual stocks, great as well. For me personally, ETFs are the way to go. That is really what I recommend, just because they always have a very good, strong performance, and also that risk mitigation factor that we talked of being kind of all through there. So guys, let me see if we got any more questions over here in the chat. Again, really wanted to start at the basics, got a lot of really basic questions of the stock market. What do we buy? And the big one, of course, how do we buy it? So where do we get that brokerage account? Again, we have those links down below for M1 and Robinhood. If you're looking to go ahead and open a brokerage account, you can go in there, you can look through their ETFs. You know what? Even pick out a few ETFs, go through there, see what they hold, see what the performance is, see kind of what the plan is. There is so much research that you can do. Literally, if you put in a ticker symbol, just like what Charlie put up there for the VOO, go to the Vanguard website, look at the Vanguard S&P 500, look at the performance, the companies that it has, the price ratios for it. There is so much research. And again, I recommend doing your research yourself, spending some time, especially going through and understanding finances like I do. I've been doing it, and I've been around finances and financial advisors in a financial institution for almost 17 years now. So it's been a ton of time that I've been dealing with kind of stocks, ETFs, investing, as well as the big financial counseling piece that I use, that I do help people not only get out of debt, really do personal finance, do the debt-free journey like we have right back here. It is absolutely getting there, and I love doing it, and I love being able to chat with you guys and talk to you guys during the live streams. Something that I'm super excited to do on a regular basis. We're going to be trying to live stream every single week on the channel. That way we can get a lot more information. I can answer questions one-on-one. But of course, if you do have any questions, drop them in the comments down below on the video, and I will definitely get to them. So guys, that is going to do it for our live stream. Again, love all the questions. Charlie, your portfolio is looking good. Kathy as well. Yeah, definitely great information. It's what we're trying to get out there, because unfortunately, when it comes to investing, when it comes to personal finance, retirement, all of this, they don't teach. And I'm really kind of bummed with my kids. I have two kids that are in elementary school now, but when it comes to the financial, the personal finance or the financial literacy piece, they don't teach it in formalized education as of today in Michigan. So it has to come from somewhere, guys. And a lot of people don't have a reliable source that they can actually bounce some questions off of and really get an understanding of what it is. Sorry, guys. Again, that's going to do it for our stream. Thank you guys for watching. And always, if you have some questions, drop them down below. Awesome to see. And stock market basics, definitely covered for the beginners. Let me know in the comments what you guys think. And as always, thank you guys for watching.